Bitcoin is moving again, but price alone does not explain the full story. The better question is not only where Bitcoin is going today, but what is actually driving the move. Welcome to the Calm Metrics. This channel looks at markets through data, liquidity, structure, and risk. This video is not financial advice, and it is not a trading signal. Today we will read Bitcoin through 5 layers: price structure, Bitcoin dominance, stablecoin liquidity, macro conditions, and investor behavior. The goal is not to predict every candle. The goal is to understand the market environment with a calm framework, so we do not react emotionally to every move. First, price structure. A Bitcoin chart shows where the market is, but it does not always explain why the market is moving. When Bitcoin rises quickly, many people feel pressure to enter. They see momentum, they feel fear of missing out, and they worry the move will continue without them. But a calm investor does not chase the first green candle. A calm investor asks what is confirmed, what is still uncertain, and where the risk is. The key questions are simple. Is Bitcoin building higher levels? Is support being respected? Is the move backed by real participation or only short-term emotion? If Bitcoin is building higher lows and holding important areas, the structure may be improving. But if price moves too quickly without support, the move can become fragile. Fast moves often attract late buyers. Late buyers are usually the first to panic during a pullback. This is why the Calm Metrics starts with structure, not emotion. The second layer is Bitcoin dominance. Bitcoin dominance shows how much of the crypto market is concentrated in Bitcoin compared with the rest of the market. When dominance rises, capital may be choosing Bitcoin over smaller crypto assets. That can suggest caution, institutional preference, or defensive positioning inside crypto. When dominance falls, risk appetite may be spreading into altcoins. That can create opportunity, but it can also create higher volatility. Dominance is not a buy or sell signal. It is a context tool. It helps us understand where capital is concentrating and whether the market is Bitcoin-led or rotating into broader crypto risk. A Bitcoin-led move and an altcoin-led rotation are not the same market environment. That difference matters for risk, timing, and expectations. The third layer is stablecoin liquidity. Stablecoins often act like dry powder inside crypto because they represent capital that may already be inside the system. When stablecoin supply grows, more capital may be available inside the crypto market. When stablecoin supply is flat or falling, rallies may have less fuel behind them. Liquidity does not predict every candle, but liquidity helps explain whether a move has support behind it. Price is the headline. Liquidity is the fuel. A market can move on emotion for a short time, but to continue, it usually needs capital. This is why liquidity matters more than hype. If price rises while liquidity is weak, the move may be more vulnerable to sharp pullbacks. The fourth layer is macro. Bitcoin does not move in isolation. Interest rates, the dollar, bond yields, stocks, and risk appetite all matter. When rates are high or uncertain, investors often become more selective. Risk assets can still rise, but the market usually demands stronger reasons. When the dollar strengthens, global liquidity conditions can become tighter. When equity markets are strong, risk appetite may improve. When markets expect easier financial conditions, risk assets can benefit. But expectations can change quickly, and Bitcoin often reacts to those changes. A calm investor does not only ask if Bitcoin is bullish today, A calm investor asks what liquidity, rates, the dollar, and broader risk appetite are saying together. The fifth layer is investor behavior. Markets do not only move because of data, they also move because people react emotionally to data. When Bitcoin rises, many people feel fear of missing out. When Bitcoin falls, many people feel fear, doubt, and regret. This emotional cycle causes many traders to enter late, oversize, or exit badly. The Calm Metrics framework is designed to slow that process down. Instead of reacting to every candle, we ask 5 questions. Is price structure improving? Is Bitcoin dominance showing capital concentration? Is stablecoin liquidity growing, stable, or weakening? Are macro conditions supportive or pressuring risk assets? Is investor behavior calm or becoming emotional? A stronger setup has several layers working together. Structure improves, liquidity is healthy, macro pressure is controlled, and sentiment is not euphoric. A weaker setup looks different. Price rises fast, liquidity is weak, macro pressure increases, and emotion becomes too aggressive. This is the difference between understanding a market and chasing a candle. The goal is not to predict every move. The goal is to stay calm when the market becomes emotional. Here are the key takeaways. Bitcoin price action matters, but price alone is not enough. Dominance shows where capital is concentrating. Stablecoin liquidity shows whether the market has fuel. Macro conditions shape the background for risk assets. Investor behavior can turn useful information into emotional mistakes. The Calm Metrics framework is simple. Structure first, liquidity second, macro third, behavior fourth, and emotion last. This is market analysis, not financial advice. Stay calm, read the data, and respect the risk.